This number doesn't mean a lot to most of the world, but if you're in the UK, it does mean a lot. It impacts your take-home pay, your student loan interest, how much you pay in dividend and capital gains tax. It is one of the most important numbers in the UK tax system, and most people don't realise just how much changes once you cross it. Often paying far more tax than they need to, but with a little bit of planning, you can change all of that. If you earn around this level or expect to in the next few years, if you're a high rate taxpayer, this video is about how you can keep more of what you earn. First, let's clear up the biggest misconception, because this does trip a lot of people up. Once you earn over this amount, it's only every extra pound that gets taxed at 40%. Not all your income, just the marginal amount above £50,270. So if you earn £51,000, for example, you're not paying 40% on all of that, only £830 of it. That's just income tax, of course. Once you add in national insurance and student loan, the tax burden does get heavier. And as you can see, the marginal tax rates, particularly those of student loans, are high. That is pretty grim. And it is where people feel disincentivized to work, where you get a pay rise, and I've felt this myself, but you barely notice the difference from month to month. But this isn't a video complaining about our tax system. It's ultimately about understanding it and working with it. So here are 9 things you need to consider when you cross this income threshold of £50,270 and become a higher rate taxpayer. Pensions. This isn't very sexy, but they suddenly matter more for 2 key reasons: tax relief and tax rates. As you're now a high rate taxpayer, you get 40% tax relief. This means the true cost of putting £100 into a pension falls from £80 to £60. Think of it as, once you're earning over £50,270, for every 60 quid you take as cash or salary now, you could have put £100 into your pension. And if you're getting an employer match on that £100 too, you get an instant 233% return on your money. I'll put the maths on the screen. Secondly, because you can use pensions to get back under the £50,270 income level to pay 20% income tax again rather than 40%. Let me introduce to you adjusted net income. Also not very sexy. For most people though, this is your salary minus your pension contributions. There is a bit more to it. Here is the government website that explains it, and I'll link that down below. But for most of us, that is what it will be. This is a key number for a few important tax cliffs, as they're known. But long story short, and I'll put the maths on the screen again, you can make pension contributions to move yourself back into the basic rate band, meaning you don't pay the higher rate 40% income tax at all. These 2 pension points you can also combine for maximum tax efficiency. There's 7 other points worth noting when it comes to pensions, and let me quickly rattle through them so you're aware. The main downside is that you can't access the money until later in life, and lowering your salary can impact things like mortgage applications. Having the money today might actually be better. For example, saving for a house deposit, even if having the money today isn't necessarily tax optimal. Saying that, you often get a lucrative tax mismatch where you avoid tax today at 40% because of the tax relief, but you only pay 20% income tax on withdrawal. If you have a workplace pension and it's set up through salary sacrifice, this also reduces how much national insurance you pay, making pensions even more lucrative. Based on current proposals though, from April 2029, the government is planning to cap the amount of pension salary sacrifice that's exempt from NI to £2,000 a year. So if you're on a salary sacrifice scheme right now, it's important to try and take advantage of this over the next few years. Even if your employer doesn't offer salary sacrifice though, just to re-emphasize, paying more into your pension reduces your taxable income and it still gives you tax relief. I just wanted to make that clear, particularly that tax relief on income tax hasn't changed and isn't changing. That's pensions. But once you cross into the high rate band, a few other things happen. Your personal savings allowance is cut by 50%. Dividend tax rates jump nearly 4 times as high, and capital gains tax rates also jump by 6%. Because of all of this, your ISA strategy becomes unbelievably important. And if you're not using ISAs properly, you may pay tens of thousands of pounds extra in tax over your life. Now, ISAs, of course, don't reduce tax today, but they massively reduce your future tax, especially if you're earning well. And that's why ultimately you likely need an ISA or ISAs on top of your pension. From an investing perspective, any dividends or gains outside of an ISA or pension in a general investment account are potentially taxable. As you can see, the tax rates for these become high and the tax-free allowances are relatively small. So long story short, you need to be using a stocks and shares ISA to invest. From a savings perspective, and this is often forgotten about, your personal savings allowance, essentially how much you can earn in interest before you pay tax, gets cut from £1,000 to £500 as soon as you become a higher rate taxpayer. That means any interest you earn outside of an ISA is potentially taxable at 40%. This is best illustrated with some numbers. If you have 20k in savings, for example, earning 5%, that's £1,000 in interest each year. As a basic rate taxpayer, no tax is due. As a high rate taxpayer, £500 of this is taxable and you'll lose £200 in total to tax. It's also worth being really clear here that this interest is added to your earnings to determine what income tax band you fall in. So if you're earning just below £50,270, your interest might push you over. And if you do go over, that personal savings allowance gets cut in half. Now, I think the ISA allowance is still better used for a stocks and shares ISA, assuming you can max it out, and that's because the dividends and gains compounded over the long term in a stocks and shares ISA should outperform the interest earned on cash in a cash ISA. But if you have ISA allowance left over at the end of the tax year and have excess cash sitting outside of an ISA that you're not going to invest, it could be worth sticking the excess cash in a cash ISA to utilize the rest of your ISA allowance, and you'll then avoid paying any tax on that interest going forward. So that's one way to get over this smaller personal savings allowance as you become a higher rate taxpayer. That is pensions and ISAs, but there's 4 more additional points to make. Who would have thought this one number would be so consequential for us in the UK? But it also impacts child benefit, work benefits, student loans, and marriage allowance. First, the child benefit trap, which is huge for parents. Even if you're not one, it's worth knowing this. If you have 2 children, your effective tax rate can exceed 60%. Similar to before, you can make pension contributions to bring your income back below that level to keep your child benefit, reduce your tax, which is a win-win. Next, work benefits. And it is worth at this income level having a think between your salary today versus your benefits today. Things such as electric car schemes, cycle to work schemes, any tech or other work benefits can come out of your salary to bring your taxable income back into the basic tax rate band. Now, this next one is mental, but if you're on a Plan 2 student loan, your repayments rise with income, but the interest rate also rises with your income. Your student loan interest rate increases drastically as you earn more. This is slightly above the £50,270 level that we're talking about here, but it's not far off, so it's worth knowing. Now, when it comes to student loans, it's generally not worth overpaying them because of how the system works. But at this point, when you get to this income level, it is worth considering, as if you overpay, you might be able to save how much interest you pay over the long term. It is very situational though, and it can be hard to forecast because it really depends on so many factors. Another thing that happens once you cross £50,270 worth of income is you lose access to the marriage allowance. Now, it works out to be a relatively small amount of 252 quid a year, but from a household income point of view, that of course increases the tax you pay. So I do think at this point, household planning starts to matter more or as much as individual planning to ultimately keep more of the money in the family and in the household. Once again, for all of these 4 points, pension contributions can bring your income back below the relevant thresholds. Finally, let's talk about self-employed people with limited companies or those who are working as employees and are earning money on the side through a limited company. Long story short, once you earn above £50,270, it's less tax efficient to withdraw money from the company, because you're paying corporation tax and then high marginal personal taxes. And now this is where pension company contributions, timing of income taken between years becomes much more important, and particularly that first one, once again, pensions and making limited company contributions into your pension. Crossing £50,270 isn't a problem. In fact, it means you're doing well and you're earning more money, but it is the point where planning starts to matter much more. There are likely a few things you can hopefully take and implement from this video, but it is worth saying, and I did want to end by saying this, that you obviously need to also enjoy your life and enjoy today. even if some decisions aren't necessarily tax optimal, your well-being, sanity, and enjoyment of life are equally important, because you're probably working hard, so you deserve to enjoy yourself as well. I think it's important not to forget that, and to ultimately try and bear that in mind as you, of course, do try to optimize and maximize your income, your taxes, and your finances. If you made it this far in the video, I appreciate it. Please let me know what you thought of this video in the comments down below. And we talked a lot about pensions in this video. So if you have a workplace pension and you're looking to maximize your workplace pension, watch this video here on screen next.